If you are a finance professional who's looking to make a career in investment banking or venture capital, or if you are an analyst who wants to understand how to navigate through term sheets, or if you are a founder of a company, a new age founder who wants to understand term sheet and how the clauses will affect you, this video might help you. Hello everyone, I am CA Vaibhav Jain, and in today's video, I'll be discussing term sheet with you. In this video, I will be covering an overview of a term sheet and also a clause by clause discussion on each of the clauses of the term sheet. We will also try to discuss each important clause from the angle of a company as well as from the angle of a investor so as to maintain clarity on each of the clauses. On that note, let's begin. Now, while I cut here. Now, firstly, obviously, what is a term sheet? So, term sheet in essence is nothing but a letter of interest or a letter of intention or an expression of intention. You can call it whatever. Basically, whenever an investor is actually interested to invest in a company, the investor issues what is known as a term sheet to the company. And the term sheet basically contains some of the preliminary clauses basis which the investor and the company have a mutual agreement for the investment, right? Now, this term sheet can be legally binding and this term sheet can be not legally binding, which means that the term sheet can either be a non-binding term sheet or the term sheet can be a binding term sheet. How does it impact an investor or a company is that in case the term sheet is a binding term sheet and both the parties sign the term sheet, in that case, if the investor um, walks out of the agreement or if the company walks out of the agreement, there will be some sort of legal enforceability to protect this. Whereas in case of a non-binding term sheet, the investor can walk out of the deal or the company can walk out of the deal without having any legal binding attached to it. In India, at least in my experience, I have only seen non-binding term sheets. Binding term sheets are not common in day-to-day transactions. That's one part of it. And secondly, when we say a non-binding term sheet, it does not mean that the term sheet does not have any legal backing to it. There are certain specific clauses. For example, the clause of confidentiality, which we'll cover later on. For example, the clause of exclusivity or expenses, and so on and so forth. So there are certain clauses which will have a legal enforceability, but all in all, the term sheet in itself is not a binding term sheet, so to say. Now, as you know, in any law or in any document, which is a legal document, the document starts with defining a couple of key terms, right? So in the term sheet also, we define the term sheet as a term sheet. Effective date means the signing of the term sheet. Now, in the term sheet, you'll also see another term known as the closing date. And here we are reading effective date. So the difference is that when we say effective date, we mean the date on which the term sheet is signed. And when we say closing date, it refers to the date of definitive documents, when the definitive documents are executed. So whenever we talk about closing date, it refers to the definitive documents and not the term sheet. Now, also, it is important to understand what are definitive documents. So, when we sign a term sheet, what is followed by that? See, essentially, a term sheet is signed, then what follows is a process of due diligence. So, there can be financial due diligence, vendor due diligence, commercial due diligence, tax due diligence, and so on and so forth. Once the due diligence is completed, the investors and the company or the founders they come and sign together definitive documents. Definitive documents means the shareholders agreement, the share subscription agreement, and in case there is a secondary round, the share purchase agreement. So here we have our closing date when this is executed. Here we have our execution date. Once the definitive docs are signed, within a couple of days, the actual wiring of the amount happens, which means the investment is completed. Right? So this is the process. Now, The next term is the proposed transaction, which means what is the investment amount, at what valuation, etc. That is the proposed transaction. Company means the investee company. Investor means the single investor or a group of investors who are a party to the term sheet. Promoters means the promoters of the company. Now, this draft term sheet, which I've downloaded from startup.gov.in, this draft term sheet also mentions the fact that the term sheet is only an expression of interest and it is a non-binding term sheet wherein it does not constitute an offer or agreement, etc. Which means, as I was saying, it is a non-binding term sheet. Also, it says that except for clause 4, which will be legally binding on all the parties here too, which means that clause 4 would contain these sub-clauses on confidentiality, exclusivity, expenses, and so on, which will be legally binding on all the parties to the term sheet. Now, on that note, this particular term sheet, which is on the screen, has been structured into four parts. First part is the transaction details, which gives you us an overview of the proposed transaction. The second part is key considerations, wherein we are discussing the most crucial matters of a term sheet. For example, board composition, anti-dilution, ROFO, ROFR, etc. The third part will be documentation and incidental matters, and the last part is the general matters. And just note that these general matters are something which have a legal binding on the parties to the term sheet. Now, let's discuss the term sheet clause by clause. See, on the first clause of the transaction details in essence are just facts and they do not have um, that sort of a discussion point of view. So, for example, subclause 1 on business says that the company is engaged in the business of X. Subclause 2 states that who the founders, or sorry, the promoters are. Subclause 3 states the current capital structure of the company. Subclause 4 states the instruments, basically, what are the equity shares. For example, if I'm investing in the equity shares of the company, then the subclause 4 will state that the company has equity shares which have a face value of this and the price of this for the purpose of the proposed transaction. Subclause 5 will state the valuation. So either it can be a pre-money valuation or a post-money valuation, whatever is agreed upon. And lastly, we have a proposed transaction clause wherein we are saying that the investors will invest a particular amount into the company, right? Now, understand one point that given it is a non-binding term sheet, all the matters written herein are subject to change. For example, let's say if I have agreed that the pre-money valuation of the company is $100 million. It is not necessary that in the definitive documentation stage, the pre-money valuation will remain the same. What has been agreed upon term sheet is more of an indicative pricing and an indicative infusion. Later on, the infusion or the pricing both are subject to change at the definitive documentation stage. However, when an amount is fixed into the definitive docs and the definitive docs has been executed, in that case, the amount or the valuation won't change. That is what is final, and basis that the wiring it happens. Let's say once the definitive docs have been signed, and in case there is a further negotiation between both the parties wherein they agree to a change, in that case, the definitive docs will have to be revised because the definitive docs are the ultimate Bible in case of a transaction. The term sheet herein contains Schedule 1, wherein we are saying that what is the shareholding or the cap table of the company as on effective date, which means as on the date on which the term sheet is signed. And Schedule 2 contains the shareholding or the cap table of company as on the closing date, which means once the investment has been done, which means this is the post-investment shareholding or the cap table, and Schedule 1 is the pre-investment shareholding or the cap table. There is an optional clause in subclause 7 wherein the company might be issuing advisory equity to someone. Let's say there is an advisor or there is the investor itself who is providing any advisory or mentoring services to the company in exchange for equity. In such a case, The company might decide to put that clause into the term sheet itself. However, as I stated, this is an optional clause. So this completes the transaction details, and as you saw, these are more of a fact-based statements rather than a legal statements, right? Now we jump on to the legal part or the key considerations, which is very important for you as a investment banker, as an investor, or as a founder. And hence we'll spend more time on these clauses. Now let's understand the first subclause on board composition. See, the board composition firstly will be subject to the Companies Act, right? Now let's say the board composition limit stands well within the Companies Act. What happens in that case? In that case, understand the fact that as an investor, when I'm investing some amount into the company for some stake, let's say a 26% stake, right? So what I will do, I will say that okay, I have a stake in the company, which means my shareholding has a voting power in the company. But this voting power is as a member of the company. I do not have a voting power as a board of the company or as a management of the company, correct? And therefore, what I will do is that as an investor, I will ask the company for a seat in the board of directors of the company. Now let's read the clause. The board of the company immediately upon closing. Here again, mark that it is saying upon closing and not upon execution shall comprise of X directors, of which the investor shall be entitled to nominate X directors. I have seen term sheets wherein the investor has even asked for two nominee directors instead of one. So this can actually change. In the event of increase decrease in the number of directors, the number of directors shall be proportionally increased or decreased as nominated by investors and promoters. And lastly, there is the clause of board observer, wherein the investor is saying that on top of a director, I also want an observer. So understand this point. Let's say I am an investor who takes up 26% stake or a 20% stake in company XYZ Limited. Now, given that I have a decent shareholding in the company, in the board of the company, board of directors of the company, I say that okay, there is a promoter director. Let's say I come in at Series C round. Okay, there is a Series A director and there is a Series B investor director. Now, let's say in Series C, I am the only one participating. So, I am asking the company, allow me to have a Series C director or a Series C investor director, right? And in that case, what happens is that the company says, okay, appoint one director to the board. That is fine. However, understand the fact or the fate of the investor director that the investor director might be a director to 40, 50 boards because he might or she might be a director to all of the portfolio companies, and hence they actually go on and ask to allow them an observer seat in the board as well. Observer seat is nothing but a person who attends the board meetings but does not have a voting power in the board. These directors have a voting power, right? But an observer does not have a voting power in the board of the company. They actually go on and take notes of the meetings, etc. So they are more of an observer of the meeting. That's one part of it. And as I said, the investor might actually go on and ask for more than one directors on the board of the company. Now, further, let's evaluate it from the viewpoint of a company as well as the investor. In the case we are discussing, I think that it is logical and fair for the investor to ask one investor director and one observer. And I think the company might agree to this as well. But what happens when a company, or sorry, when an investor is asking for two investor directors? This is a case where the company will say, why will we allow you two investor directors? And in this case, I have seen counter arguments from both the sides. So herein, the company says that why do you want one more additional investor director? And the investor says that there is a reason for that. The investor gives such reasons that given that we are coming in at this stage wherein let's say we are investing $100 million, So we want two investor directors because we are putting in significant sum into the company. They might also further say that the earlier investors who came in for a smaller check, or the earlier investors now have been diluted a lot, but we are holding a significant stake in the company, and hence we want a higher voting power in the board of the company. The company might counter, saying that we want to treat all our investors at par, and even though the investment amount of previous investors was less, let's say someone invested a $10 million and Series B invested a $30 million. In that case, the company's argument is also fair. So what actually happens is that both the parties actually have to come into a middle ground and close the deal. Now, what is true, what is wrong, that is depending on the negotiating power of both the parties. However, this is a scenario that can happen. The second subclause is on the preemptive rights. Now, understand the preemptive rights. I'll use the same numbers, almost the same numbers. So let's say in the Series B round of the company, investor was me, and I invested, let's say, $30 million, or let's say $20 million at $100 million post money. This means that I will have a 20% stake in the company. Now, let's say the company goes on and raises Series C round, wherein a new investor, ABC, comes in, and for the Series C round, the company wants to have an infusion of $40 million at a $200 million post money valuation, which means this will be a roughly 20% stake or 20% dilution. Herein, understand the point that my initial holding of 20% will now actually become 16% because I'll get diluted by 20%. So 20% into 1 minus 20%, which is 20% into 80%, makes it 16% stake. So now, as an investor, I will say that due to no action of mine, just by sitting, my stake has become diluted. And hence, I want a right and not an obligation, a right to prevent my stake from being diluted due to further fundraise by the company. And hence, what I will do is that in the Series C round, I will say that okay, you want $40 million, do one thing, you raise everything from the market, but allow me to put that much money that will prevent me from being diluted, which means I will put in that much money at the same price, at the same post money valuation, which will increase my stake by the 4%, which is the amount or which is the percentage by which I was being diluted, which means I will put in $8 million, which will give me 4%, and I will ask that okay, from the new investor ABC, you go on and raise $32 million at 200 million post. This will give the new investor 16% stake, and this will give me 4% stake. So now my stake will become 16% plus 4%, 20%. The new investor ABC's stake will become directly 16%. So what happened in this case was, from a company's angle, the company got to raise whatever it wanted, which is $40 million. From an investor angle, I got to maintain my shareholding in the company by executing my preemptive right, and the company got to bring in a new shareholder into the company via further fundraise, right? So this is what is preemptive right. The clause states that the investor shall have a pro rata right to participate in future issue of the shares by the company to any third party, which is ABC in our case, and to retain their shareholding. Understand the point? This clause says retain their shareholding. As in our example, what I did was from a stake of 20%, I got diluted to 16%. So I only invested that much, which will enable me to go back to 20%, right? Which means retain my shareholding. This clause or this right does not entitle an investor to increase their stake just by virtue of this right, right? Now, it also says that there will be same terms and conditions, including price. So even in our example, we use the same post money valuation of $200 million for both the future investments. Now understand this clause from both the angles. Although we have already understood, but why is a preemptive right important? Because see, in any company, when an investor is coming in, the investor would want to get a significant chunk of profits. See, end of the day, for an investor, one important thing is MOIC or a multiple on invested capital. And they want to maximize their MOIC, they want to maximize their IRRs. So what they would want is a right to invest in a company if they want to maintain their stake in the company. And therefore, they ask for a preemptive right. Now, when a further round is being done by a company, if the investor has that sort of dry powder, if the investor has the capital to further invest in the company, the investor might choose to execute this right and understand the point that this is a right and not an obligation, which means that in this case, the investor, which is me, VJ, I could have chosen not to put in this amount. I could have chosen that the company raise the entire $40 million from a third party and with zero participation from me. That is my right. But in case I wish to execute my right, the company cannot stop me from putting in that $8 million at a $200 million post money. This is a preemptive right. The third clause is anti-dilution. Now understand the case. Let's say Series B round, I came in and I invested $20 million. Now let's assume the per share price was 100 rupees per share. Now the company goes to the market and raises a Series C round, right? And let's say the company raises what? $40 million at $20 million post. Sorry, $200 million post. So let's say the company is raising money at 180 rupees per share in the next round, right? In this case, as an investor, what VJ can do is VJ can use his preemptive right to protect his stake from being diluted. This is clear to you. We discussed it. But let's assume a scenario wherein the further round which is happening, the Series C round, that happens at a price of 70 rupees per share. In this case, I am having a trouble. I am saying that I came in at 100 rupees per share and now you are raising funds at 70 rupees per share, which means this is a down round. A down round is basically a round wherein the price per share is less than what it was in the previous round. And in a case of a down round, I am saying to the company that you are diluting me over and above what a normal dilution would be. For example, had the funds been raised at 180 rupees a piece, I would have been diluted by X percentage. But in case the fundraise is happening at 70 rupees per share, my dilution would be 2 3x of what it ideally would have been, right? And in that case, to prevent such a situation from happening, I am asking the company to give me a protection from such a scenario. Mark the words protection. So protection from anti-dilution, protection from dilution, basically anti-dilution protection in case of a down round is what is this clause talks about. Now let's read the clause. It says that if any time after the closing, which means obviously once the round has closed, the company issues to any third party equity shares or instruments convertible to equity shares, generally CCPS, at a price per share that is lower than the price paid for the equity shares, which means a down round. In that case, this clause further states that the investor shall be entitled to anti-dilution protection on a broad-based weighted average basis. What is this broad-based weighted average basis? This I'll discuss with you on a in a separate video. Basically, to protect anti-dilution, there are multiple methods, or I think three main methods. Of the right now in my head, I remember broad-based weighted is one. Second is full ratchet. These two are more commonly used. I think there was a third one, but I don't recall. However, in my experience, I've only seen broad-based weighted average and I have not seen full ratchet in any term sheet. So this clause says that we will use the broad-based weighted average formula to prevent or to protect the investor from being diluted in case of a down round. Now further understand the point. In this case, when I was giving you an example, I said that to protect my stake, I am putting in an $8 million check to get a 4% stake in the company, right? This was preemptive, right? But in case of an anti-dilution, I will not be putting in more money. Understand the point? Here the clause says that the company forthwith takes all necessary steps to issue additional equity shares to the investors. These additional equity shares may not actually be requiring the investor to pay any amount for such shares. And hence, the company might have to issue free of cost shares to the investor to protect their stake from being diluted in case of a down round. Now, again, if you look at it from an investor angle, this clause makes sense because the investor is saying that if a down round is happening, in that case, I do not want my stake to be diluted unnecessarily. So, as a company, as a promoter, it is your responsibility to prevent my stake from being diluted in such a scenario. On the contrary, imagine this situation from a company angle. Now, see, as an investor, you are investing into what? Equity, or let's say CCPS, which in essence is something which will be converted into equity. So, the investor, in essence, is asking to do what? The investor is asking the company to prevent the equity risk or to hedge the equity risk. Just like let's understand the situation. Let's say I invested in Kotak Mahindra Bank, and the shares I invested in was 1600 rupees, and now the share prices have crashed to 1400 rupees, and the company is raising fresh funds at 1400 rupees. So, as an investor, do I go on and say to the company that you have to issue me additional shares at 1400 rupees, or issue me additional shares to protect my stake in the company? No, I do not do that, right? Because that is the equity risk which I am undertaking. But via this clause, the investors are actually asking the company to prevent or protect them from a equity risk of a down round. Note the word down round because anti-dilution clause is only used in case of a down round. In case the actually it is a up round or a round wherein the price is higher than the previous round, in that case I won't execute or I do not have anti-dilution rights. I have preemptive rights. I hope I'm clear and I was able to drive this point. Now let's go to the next clause, subclause 4 on promoter lock-in. Understand the point again. I am a Series B investor. I am investing into company XYZ Limited, where the promoters are Mr. X, Mr. Y, Mr. Z, right? Now I am investing on the company because of couple of reasons. For example, the scale of the company, the quality of the company, the profitability of the company, as well as the promoter set. Now, imagine my fate if these guys, once I invest into the company, they sell their shares and exit the company as a shareholder. This means that they will not have any skin in the game, and that will put me in a very troublesome situation. So again, a very logical clause. I go on and say that I am putting in a lock-in clause on you guys, wherein as a promoter, you will be prevented from selling your shares for X number of years, in the given case, 3 years. This 3 years is a lock-in clause. This clause further states that in case these guys want to sell their shares before the lock-in period, in that case, they have to take a written approval of the investors. The clause further states that this particular exit will also be subject to the right of first refusal of the investors and the tag along right which is available to the investors. I will discuss both of these clauses later on. So, if we read the clause now, the promoter shall not be entitled to transfer to any person the shares held by them in the company directly or indirectly for a period of X number of years from the date of closing. Again, from the date of closing, which is known as the lock-in period now. The promoter may, however, transfer the shares to any person during the lock-in period subject to prior written approval of the investors and ROFR and or tag along right. So this is what is a promoter's lock-in clause. And now understand the importance of this clause from the company's or the promoter's angle. Now, as a promoter, If I'm prevented to sell my stake at all, it is also a very adverse situation for me. Because imagine in early stage companies or early growth companies, the promoters do not end up drawing a lot of salary. And in case there is some sort of emergency with the promoter, the only option to get money is to sell their shares, maybe to the investors, existing investors only. But they want to sell their shares. And in that case, if there is a absolute lock-in for them, then that is a troublesome situation. And hence, this caveat is given to them that in case there is a written approval of the investors and ROFR or tag along, then in that case, they can sell their shares to either the investors or the third-party buyers to get some liquidity for their emergency situations. The next clause is vesting of promoter shares. So, this is a clause which is also there in the definitive documents. I have not seen this clause in most of the term sheets. However, what this clause actually states is how the promoter shares will vest. So understand the point that the promoter shares are unvested in nature at the beginning. So through this clause, what the investor and promoters are agreeing is that X percentage of the shares will be deemed to have vested and the remaining, let's say 25% shares have been deemed to be vested, 25% of the promoter shares. And then for the 75% shares which are unvested, which remain unvested, we will prepare what is known as a vesting schedule, right? So it can be made as such that let's say we say that the promoter shares shall vest over 4 years period, right? And I can put a clause that the vesting will start at the end of the first year from the date of closing, which means my first vesting will start from here on. However, I can further say that it will be a quarterly vesting, which means the promoter share will first vest in the 15th month after closing because the vesting starts after 1 year, which is 12 months, and the vesting is on a quarterly basis, which means 3 months. So 12 plus 3, 15th month. This is what the clause also says. The clause says that 25% of the shares, it can be mutually agreed upon, shall be deemed to have vested on the date thereof, and remaining 75%, which is the unvested shares, shall be vested over a 4 year period starting from the date of closing, as we discussed. This is known as the vesting period, and the way in which the vesting will happen is known as the vesting schedule. It further says that the vesting will happen in equal installments and it will happen every 3 months, which is a quarterly basis, which means the first vesting will happen in the 15th month, as we discussed. Then it further states that in case of termination of promoter's employment, what will happen to the unvested shares? So it can either be transferred to the company, it can be also disposed of in a manner determined by the board and investors. Now understand the point termination of in any of the promoter's employment. See, whenever a company raises funds, the promoters actually end up entering into a employment agreement with the investors or the shareholders actually investor because this is also an important document. So, basis the promoter employment agreement or basis the employment agreement, there are certain clauses which can lead to termination of the promoters. For example, a major reason for termination is cause. You might have heard termination because of cause, termination due to cause. And in such scenarios, the unvested shares of the promoters actually have to be disposed of. Whatever has been vested till date, that belongs to the promoters. But whatever is not vested, that is something which needs to be disposed of, and that is what has been discussed or what is discussed either in the term sheet or in the definitive documents. So this is the vesting clause. The next two clauses are ROFO and ROFR. Sometimes these two clauses are collectively known as matching rights or individually known as matching rights. Now let's discuss ROFO and ROFR. Now understand my point. I again am a Series B investor, VJ, and I had put in some money into the company for certain stake, right? Now imagine that post my investment, the company raised Series C round. Okay, Now, post Series C round, as an investor, I want to sell my shares, right? Then what alternative do I have? See, one part is the IPO story, etc., which is a scheduled exit, which we'll cover later on. But let's say the scheduled exit has not yet happened and still I want to dispose of my shares. In that case, there is a restriction on my disposal. See, I am a Series B investor, right? An ideal way for me would be to go to a third party buyer who's interested to buy my stake and just simply sell the shares to the third party buyer for some amount, right? But because of clauses like ROFO, which is the right of first offer, I will also tell you why it is named so. I cannot directly sell to a third party buyer. The clause states that in the event I want to sell to a third party buyer, I will first go to the promoter and offer the shares to the promoter. The shares, let's call them ROFO shares. Now, once I go to the promoter and offer these shares to them, the promoter will come back and give me some offer, which is known as the offer price, right? Now, let's say the promoter offers me 100 rupees as a offer price. In that case, what I will do is then I will go to a non-selling investor. See, I am selling my shares, so I am a selling investor. And the investors or the shareholders who are not selling their shares, they are the non-selling investor. I will go to a non-selling investor. I will communicate to them that the promoter has given an offer price of 100 rupees one. So basically, let me put it this way. As a selling investor, I go to a non-selling investor wherein I have a promoter offer price one, or if the promoter has refuse to buy my shares. In these two scenarios, I go to the non-selling investor. So let's say the promoter has refused. In that case, the non-selling investor give me an offer. And in case the promoter has given me an offer price, the non-selling investor has to give me a price which is over and above the offer price. Let's say 110 rupees. In case the non-selling investor gives me 110 rupees as offer, in that case I can sell to them. In case they do not give me a price which is higher than the promoter offer price, I cannot sell to them. This is how the clause works. Now let's say the promoter gives me 100 rupees as the offer and the non-selling investor beats that by saying 110 rupees is the offer. After that I can go to a third party buyer and solicit another offer. Let's say the third party buyer gives me a price of 120 rupees. So now understand, I can go to a third party buyer wherein a non-selling investor actually refuses or a non-selling investor gives me an offer. After these two cases, I go to a third party buyer to procure an offer. Now, if a third party buyer gives me 110, 120 rupees as an offer, I will go to the non-selling investor and I will communicate to them that are you willing to go over and above 120? If they say yes, I can sell to them. If they say no, then I will sell to the third party buyer. So basically, through this clause, as an investor, sorry, as a selling investor, I first have to go through some of the existing folks before I try to sell it to the external people. And that actually brings in the clause of ROFO. Now let's understand this via the clause. The clause states that the selling investor, if he or she intends to sell his or her ROFO shares, then they will have to before going to a third party buyer, they will first have to offer it to the promoter. And once the promoter either refuses or once the promoter gives an offer price, in that case, they will go to the non selling investor and ask the non selling investor to give an offer which is higher than that of the promoter. So it is written that a price higher than the price at which the same was offered to be purchased by the promoters. Now understand the text. Who's giving the offer? This offer is actually being given by the promoter. I am not asking the promoter to buy my shares at 100 rupees. The promoter is saying that I will buy your shares at 100 rupees, which means that the price discovery is being done by this particular chunk of people and not by the selling investor, right? Price discovery is being done here and not by the selling investor. Then this clause further states that the selling investor shall sell the ROFO shares to non-selling investor only if the offer price is beaten by the non-selling investor. So in our example, The selling investor, which means I can sell the shares to the non-selling investor only if the price is 110 rupees, which is more than the offer price of 100 rupees. Clear? The clause further states that none of the non-selling investors agree, which means if the non-selling investors refuse, or if a third-party buyer gives a price or an offer which is higher than the offer price, which means our offer price was 100 rupees. So if the third-party buyer gives me a price which is greater than 100 rupees, in that case I can sell to the third-party buyer. Got it? So broadly, this is what is ROFO. And lastly, this clause states that the promoters and the non-selling investors shall have a right to purchase the ROFO shares in proportion of their respective shareholding. Which means, let's imagine this also. Let's say the current cap table of the company looks like the promoter has 50% stake, selling investor has a 20% stake, and non-selling investor has a 30% stake. Okay. And let's say I am selling 80,000 shares. In that case, the shares can be bought in the ratio of 50s to 30, which means 50k shares can be taken up by the promoter and 30k shares can be taken up by the non-selling investor. For shares over and let's say for shares over and above 30k, the non-selling investor cannot execute ROFO on those shares. I am free to sell shares beyond 30k to a third-party buyer, and similarly, for shares over and above 50k, the promoter um, in, cannot execute the right of first offer in this case. I am free to sell shares to a third-party buyer for shares exceeding that particular thing. Got it? Now, I hope this clause is clear to you because now understand one more thing. In the example, the obligation to follow ROFO lies with the selling investor, and the right of first offer or the right is available with whom? It is available with the promoter, with the non-selling investor, and these two come in before the third party buyer. Now understand that this is not a hard clause as such. That means that you can actually go on and negotiate who would be obligated to ROFO and who would have the right to ROFO. Which means that I have seen term sheets wherein the promoters do not have a ROFO. I have seen term sheets where all the non-selling investors do not have ROFO. There is a carve out for major shareholders wherein only the major shareholders who are holding, let's say, 5% and above, only those shareholders have the right of first offer. That is, only those shareholders can offer the selling investors to buy the shares of the selling investors. Similarly, sorry, I had to take a break. Similarly, I was saying that on the obligation side, sometimes the selling investors are obligated to go through the ROFO route, but herein as well, similarly, carve-outs might be given to specific set of selling investors or shareholders. Also, such similar carve-outs or similar specifications as to on whom the rights will be there and for whom the obligation will be there will also happen in case of right of first refusal or ROFR, which is our next subclause. So see within ROFR what happens? Now let's just quickly recap. In ROFO we said that if we want to sell the shares to someone, we have to first go to the promoters or the non-selling investors and then we can go to a third party, right? Now, in case of ROFR, what happens? Let's say I want to sell my shares to a third party buyer at 100 rupees per share. Then, because of ROFR, I am obligated to first go to the non-selling shareholders or the non-selling investors and offer the same shares to the non-selling investors at the same price at which I would have offered those shares to a third party buyer. So let's call these shares ROFR shares, which means the clause is putting an obligation on a selling investor to first offer the shares at the same price at which those shares would have been offered to a third party buyer to a non-selling investor, which means the onus of price discovery lies on the selling shareholder. Now let's read the clause. Subject to promoter's lock-in as set forth in clause 2.4. In the event any of the promoter or any of the shareholders other than the investor, basically the selling shareholder, intends to sell all or part of their shareholding, which is ROFR shares, in the company 20%, then such selling shareholder shall first offer the ROFR shares to all the investors, which means all the non-selling shareholders, at the same price at which they have offered to such person. Which means if I'm offering my shares to a third party buyer at 100 rupees, I will first have to offer those shares to non-selling investors at 100 rupees. Then the non-selling investor may accept or reject. So if they accept, they can buy those shares in proportion to their interest shareholding in the company. And in case they reject, then I can go and sell it to a third party buyer. So this is ROFR. And now understand, because in case of ROFO, the onus of price discovery lies on the buyer. Hence, it is more favorable for the seller of the share. However, in case of ROFO, the onus of price discovery lies on seller, so it is more favorable for a buyer or an investor. Got it? I think I'll take a break at this clause at 2.8 and I'll cover from 2.8 in the next part of the term sheet discussion video.